most important thing is to be able to define which ones you can come to an intelligent decision on and which ones are beyond your capacity to evaluate. You don't have to be right about thousands and thousands and thousands of companies. You only have to be right about a couple. I met Bill Gates on July 5th, 1991. We were out in Seattle, and Bill said, "You've got to have a computer." And I said, "Why?" And he said, "You can do your income tax on it." I said, "I don't have any income. Berkshire doesn't pay a dividend." He said, "Well, you can keep track of your portfolio." And I said, "I only have one stock." I said, and he says, "It's going to change everything." And I said, "Well, will it change whether people chew gum?" And he said, "Well, probably not." And I said, "Well, will it change what kind of gum they chew?" And not. And I said, "Well, then I'll stick to chewing gum and you stick to computers." I don't have to understand all kinds of business. There's all kinds of business I don't understand. But there's thousands of opportunities there. I did understand the Bank of America, and I'll be able. I'm able to do that. I'm able to understand some given percentage. But Ted Williams wrote a book called The Science of Hitting, and in The Science of Hitting, he's got a diagram, shows him at the plate, and he's got the strike zone divided into 77 squares, each the size of a baseball. And he says, if I only swing at pitches in my sweet zone, which he shows there, and he has what his batting average would be, which is 400. If he had to swing at low outside pitches, but still in the strike zone, his average would be 230. He said the most important thing in hitting is waiting for the right pitch. Now, he was at a disadvantage because if the count was 0-2 or 1-2 or so on, even if that ball was down where he was only going to bat 230, he had to swing at it. In investing, there's no called strikes. People can throw Microsoft at me and you name it, any stock, General Motors, and I don't have to swing. And nobody's going to call me out on called strikes. I only get a strike called if I swing at a pitch and miss. So I can wait there and look at thousands of companies day after day, and only when I see something I understand and when I like the price at which it's selling, then if I swing, if I hit it, fine. If I miss it, it's a strike. But it's an enormously advantageous game. And it's a terrible mistake to think you have to have an opinion on everything. You only have to have an opinion on a few things. In fact, I've told students, if when they got out of school, they got a punch card with 20 punches on it, and that's all the investment decisions they got to make in their entire life, they would get very rich because they would think very hard about each one. And you don't need 20 right decisions to get very rich. 4 or 5 will probably do it over time. So I don't worry too much about the things I don't understand. If you understand some of these businesses that are coming along and can spot things on, if you can spot on Amazon, for example, it's a tremendous accomplishment what Jeff Bezos has done. And I tip my hat to him. He's a wonderful businessman. He's a good guy too. But could I have anticipated that he would be the success and 10 others wouldn't be? I'm not good enough to do that. But fortunately, I don't have to. I don't have to form an opinion on Amazon. And I did form an opinion on the Bank of America, and I've formed an opinion on Coca-Cola. Coca-Cola's been around since 1886. There's 1.8 billion 8-ounce servings of Coca-Cola products sold every day. Now, if you take 1 penny and get 1 penny extra, that's $18 million a day. And 18 million times 365 is 7 billion, 3 less 730 billion, or $6,570,000,000. So annually, $6,570,000,000 from 1 penny. Do you think Coca-Cola is worth a penny more than Joe's Cola? I think so. So, and I've got about 127 years of history that would indicate it. So those are the kind of decisions I like to make. And you may have an entirely different field of expertise than I would have, and probably much more up to date in terms of the kind of businesses that we're seeing evolve. And you can get very rich if you just understand a few of them and understand their future. Stocks sell at silly prices from time to time. Most stocks at one time or another sell at very silly prices. And it doesn't take a high IQ to figure out that they're cheap, but it does take a temperament that's willing to step up and actually act. I tell people, if they're going in the investment business, if you got 160 IQ, sell 30 points to somebody else because you won't need it. I mean, I mean, I figured out very early, you don't have to be that smart in this business, which is fortunate, but you do have to have the right temperament. And you have to be able to ignore what other people are saying and simply look at the facts and decide, is this stock which is selling at X worth 2X? And occasionally you'll find things like that. And when you don't find them, you don't do anything. So that's my generalized stock tip, no names.
Finding that people buy stocks today or tomorrow or next week or next month. I think it all depends on your circumstances, but you shouldn't buy stocks unless you expect, in my view, you expect to hold them for a very extended period and you are prepared financially and psychologically to hold them the same way you would hold a farm and never look at a quote. You don't need to pay attention to them.
How worried are you by the declines in the share price of Berkshire Hathaway, the difficulties the company's in?
This is the third time that Warren and I have seen our holdings in Berkshire go down top tick to bottom tick by 50%. I think it's in the nature of long-term shareholding with the normal vicissitudes in worldly outcomes and in markets that the long-term holder has his quoted value of his stock go down and then by, say, 50%. In fact, you can argue that if you're not willing to react with equanimity to a market price decline of 50% 2 or 3 times a century, you're not fit to be a common shareholder and you deserve the mediocre result you're going to get. But of course, everybody's looking for the same thing. And the trouble with it is you will find when you get into those good businesses, places picked over and analyzed as American stocks are. You can imagine the amount of time spent thinking about American stocks. And you will find, by and large in America, if it's really a great business, it's at least 25 times earnings and maybe 30 or 35 or something. So that makes it much harder, of course, because if something goes wrong, you can lose a lot of your investment. And of course, that's what makes investment so difficult, is the fact that the good businesses don't stay cheap. You got to somehow recognize a good business before it's recognizable as a good business. That's very hard to do. Some people get good at it, but not many. And so I always knew from the very first, when I was a little boy, that the opportunities that were important that were going to come to me were few, and that the trick was to prepare myself for seizing the few that came. This is not the attitude they have at a big investment counseling thing. They think if they study a million things, they can know a million things. And of course, the result is almost nobody can outperform an index. Whereas I sit here with my Daily Journal stock, my Berkshire Hathaway stock, my holdings in Lilu's Asian fund, my Costco stock, and of course I'm outperforming everybody. And I'm 95 years old, and I practically never have a transaction. And the answer is I'm right and they're wrong. And that's why it's worked for me and not for them. And now the question is, do you want to be more like me or more like them? The idea of diversification makes sense to a point. If you don't know what you're doing and you want the standard result and not be embarrassed, well, of course, you can widely diversify. Now, nobody's entitled to a lot of money for recognizing that because it's a truism. It's like knowing that 2 and 2 equals 4. But the investment professionals think they're helping you by arranging a diversification. An idiot could diversify a portfolio, or a computer for that matter. But the whole trick of the game is to have a few times when you know that something is better than average, and invest only where you have that extra knowledge. And then if you get just a few opportunities, that's enough. And what the hell does you care? You own 3 securities and J.P. Morgan Chase owns 100. You know, what's wrong with owning a few securities? Warren always says if you lived in a growing town and you owned stock in 3 of the best enterprises in the town, isn't that diversified enough? The answer is, of course it is. They're all wonderful places. And that Fortune's formula, which got so famous, which was a formula to tell people how much to bet on each transaction if you had an edge. And of course, the bigger your edge, the more close the transaction was to a certain winner, the more you should bet. And of course, there's mathematics behind it. But of course it's true. It's perfectly possible to buy only one thing because the opportunity is so great and such a cinch, or only 2 or 3. So the whole idea of diversification when you're looking for excellence is totally ridiculous. It doesn't work. It gives you an impossible task. What fun is it to do an impossible task over and over again? I find it agony. Who would want to do it? And I don't see why. My father had a client. He was a lawyer in Omaha. He had a client whose husband had a little soap company. And the guy died, and my father sold the soap company. This woman was one of the richest people in town in the middle of the Depression. And what she had was a little soap company in a big mansion in Omaha's best neighborhood. And they sold the soap company. She had a mansion in the best neighborhood and $300,000. But $300,000 in 1930-something was an incredible amount of money. A little hamburger was a nickel, a big hamburger was a dime, and the all-you-can-eat cafe in Omaha would feed you all you needed to stay alive for 2 bits a day. I mean, $300,000. Well, she didn't hire an investment counselor. She didn't do anything. She's a wonderful old woman. And she just took that and she divided it into 5 chunks. And she bought 5 stocks. I remember 3 of them because I probated her estate. And it was, one of them was General Electric, one was Dow, one was DuPont, and I forget the other 2. And then she never changed those stocks. She never paid any advisor. She never did anything. And she bought some municipal bonds. She never spent her income. And she bought some municipal bonds from time to time with the incomes. By the time she died in the 50s, she had $1.5 million. No costs, no expenses. And I said, how did you decide to do that? And she said, well, she said, I thought electricity and chemistry were the coming things. She just chunked it all in and sat on her ass. I always liked that little woman. My kind of a girl.